Welcome, my friends. If you follow this channel, you already know that layoffs are basically in full-on mode in technology companies. You have heard about the 50% layoff at Twitter, the 11,000-person layoff at Meta, and the 18,000-person layoff at Amazon, and many others. Today we are hearing news that DirecTV will also cut jobs. DirecTV is laying off hundreds of employees. That includes roughly 10% of its management employees. The company is under serious pressure to reduce costs. Managers comprise half of DirecTV's 10,000 employees. The cost reduction comes as cord cutting accelerates, especially at satellite TV distributors such as DirecTV. If you follow this channel, you probably know that most of our coverage of layoffs has focused on technology companies. But as you probably also know, the United States is teetering on the brink of recession. And this is happening while inflation is raging. Interest rates are rising because the Federal Reserve is aggressively trying to fight inflation. So consumers are having to spend more of their budget on interest. And that means they are having to pull back on discretionary spending. Cable cutting has been going on for years now. But suddenly, it has kicked into high gear. Layoffs are sweeping the entire media industry as well. If you have listened to my previous videos, you already know the names: Disney, Warner Bros. Discovery, HBO, and AMC networks. What does it mean for the economy? And what does it mean for the future of the United States? But before we get into all of that, please press the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. DirecTV is laying off hundreds of employees. That includes roughly 10% of its upper management positions. The company is under serious pressure to reduce costs. There is heightened pain of cord cutting for pay TV providers. Most of the job cuts will be at the manager level. Managers comprise about half of DirecTV's 10,000 employees. The entire pay TV industry is in secular decline, said a DirecTV spokesperson. It also faces increasing rates to secure and distribute programming, that spokesperson continued. We're adjusting our operations costs to align with these changes and will continue to invest in new entertainment products and service enhancements, the spokesperson also said. DirecTV became a private company in 2021. That was when AT&T entered into a deal with private equity firm TPG to spin it off. DirecTV had an implied enterprise value of $16.5 billion at the time. AT&T acquired DirecTV in 2015 for $48.5 billion and the assumption of debt. That deal turned out to be a disaster for AT&T. But, as you probably know, it was not AT&T's only disaster under its previous CEO. DirecTV and its peers have long been under pressure from cord cutters and relentless competition from streaming services. The rate of cord cutting accelerated in the third quarter. DirecTV and Dish have experienced some of the highest pay TV subscriber losses. DirecTV no longer publicly reports its subscriber base because it is a private company. But it has about 13 million customers. DirecTV reportedly lost 500,000 subscribers in Q3. Cord cutting slowed a little during the pandemic as people watched more TV. But the cord cutters came back with a vengeance and recently accelerated to nearly 17%. DirecTV also offers DirecTV Stream. That is an internet TV bundle similar to Google's YouTube TV and Dish's Sling. Competition for subscribers has also ramped up in rural areas. That is because broadband and fixed wireless companies are building out their networks. Much of the new build-out is in areas where satellite TV providers were once some of the only TV providers. At the same time, fees to carry broadcast and cable channels continue to rise. These increased fees are a primary reason for accelerating pay TV customer losses in recent years. Also, media companies have been offering more of the same content normally found only on linear TV. Weekly shows, live events, even sports. These offerings reduce the customer value of the pay TV bundle. DirecTV's contract recently ended for the rights to the NFL's Sunday Ticket. That is the package of out-of-market NFL games. DirecTV held the rights ever since the inception of Sunday Ticket, back in 1994. Unfortunately, it has been losing about $500 million annually on the deal. But the layoffs include only a few employees connected with Sunday Ticket, the People said. If you recall from last month, AMC Networks also announced a major layoff. AMC Networks sent a memo to all employees announcing its plan for significant layoffs. The memo was sent by AMC Networks chairman James Dolan. Dolan announced that CEO Christina Spade stepped down from the CEO position. And this comes less than 3 months after being promoted to the CEO position. The layoffs are expected to happen in the coming days, the People said. AMC is controlled by the Dolan family. So if you are spending your time watching YouTube, it means that you are probably a cord cutter. I am also a cord cutter. AMC Networks derives more than half of its revenue from the linear TV bundle. That product provides more than half of the revenue that AMC Networks gets. Just to explain, linear TV is the term used to describe pre-programmed TV. It stands in contrast to streaming, in which the user selects each show that they want to watch. Up until the rise of Netflix and the overall streaming industry, all of TV was linear. And linear TV has been bleeding customers as they choose streaming services instead. AMC's quarterly revenue had fallen 16% to $682 million for Q3. AMC Networks entered 2022 with more than 1,700 full-time employees and 287 part-time employees. AMC Networks has been seen as an acquisition target for larger media companies. Peacock has approached various smaller streaming services about bundling their content. And AMC Networks also has niche streaming services such as AMC+. Paid streaming subscribers grew 44% from the prior year to 11.1 million, AMC said in its Q3 earnings call. If you have been an observer of the media industry, the term cord cutter cannot be new. Actually, it has been a phenomenon for a very long period of time. Most people think that it is only a matter of time before linear TV is forced to make dramatic changes. Now, apparently, that time has come. It is being blamed on sinking ad revenue and weakening macroeconomic conditions. But really, these factors are merely hastening the eventual day of reckoning. Linear TV has been under competitive threat from the streaming business for a number of years now. But the other notable development is that the growth of streaming has slowed dramatically. Even Netflix had 2 quarters of declining revenue in 2022 before returning to meager growth in Q3. If you follow this channel, you already also know of the problems at Disney. Disney suddenly fired its CEO Bob Chapek and rehired its former CEO Bob Iger. So, this means that market conditions suddenly changed. And those changes are what AMC and many others are now experiencing. These changes are what Dolan is referring to when he says that these are confusing times in the TV business. Actually, these times that are confusing for the corporate heavyweights are actually good for consumers. Because it means that there will actually be more intense competition for customers. We will see, and only time will tell. And really, the problems plaguing Hollywood are just the media version of what is happening to technology companies. If you follow this channel, you know that a major activist Google shareholder is demanding layoffs. Activist investor TCI Fund Management holds a $6 billion stake in Google parent company, Alphabet. TCI told Google CEO Sundar Pichai that both salary expenses and headcount must come down. According to TCI, this must be done using a much more aggressive action than by stealth layoffs. TCI has made the case that compensation and headcount at Google are just way too high. Much higher, in fact, than at other companies in the rest of Silicon Valley. Google remains one of a few tech companies that has not yet formally announced major layoffs. Right now, Google employees are nervous. Like many of its tech peers, Google ramped up hiring the past few years during COVID. One critic, billionaire activist investor Sir Christopher Hahn, claimed Alphabet's payroll was too high and should be dramatically sliced. The ever-expanding list of tech companies shedding workers is growing by the day. On Tuesday, HP said it plans to lay off 6,000 employees over the next 3 years. Last week, Cisco Systems announced its intent to slash 5% of its employees. Facebook parent company Meta Platforms announced that it is eliminating more than 11,000 jobs. And other big tech names are in on the layoff act. Amazon, Intel. Big tech companies experienced a surge in revenue and profits during the pandemic. That led tech companies to hire at a blistering pace. Now, they are experiencing the post-pandemic hangover. All of this while the United States teeters on the brink of recession. Snap announced a 20% workforce reduction back in August. 2022 has seen an absolute parade of layoffs in technology companies. Twitter laid off 50% of its employees. Meta laid off 11,000 employees. Amazon laid off 18,000 employees. Snap laid off 20% about a month ago. But, what do you think? Please leave us a comment below and hit the like button. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Please share this video on social media. Thank you for watching.